Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari.
Hello.
Thank you guys for joining us in this episode, part 2 of Visa. We had a really fruitful discussion in episode 1, part 1 of Visa. So please check that out if you haven't. In this episode, we are going to talk about Visa's financials, valuation, and we're going to do something a little bit different in this episode, which is we are going to go through this thought exercise of trying to break its moat. I think a way that Hari put it, which I think is pretty on point, is let's say you and I had, $100 billion at our disposal to create another Visa as a competitor. What would that look like? How difficult would that be? And so we'll go through that exercise in this episode to better understand their moat. Before we jump into the topics of the day, Hari, could you give us a quick disclaimer?
Yeah, this is the Value Investor TV podcast. We are here to help entertain you, educate you, and explain the concepts behind value investing. We are not financial advisors, and we don't know your specific financial situation. So, if you need financial advice or financial services, please consult with a financial advisor before making any investment decisions. Great,
thank you, Hari. All right. Oh, one more thing before we jump in. I do want to mention that this Visa company that we're analyzing today was submitted by one of our listeners. So if you guys have a company that you want us to break down, please send a list to us at info@valueinvestor.org. It just helps us to create content that will add value for you guys, the listeners. So just make sure if you have a company in mind, do send us. We'll definitely take a look. Okay, let's jump into the checklist. The first thing right off the bat, let's ask this question: does the company have enough cash to maintain its business?
I think that's a pretty easy question to answer. Right? Is that Visa here has about $8 billion in cash as of 2018. The long-term debt that they have is about $16 billion, and they didn't actually have any debt as of like three years ago. But the biggest thing that they generate about $12 billion in free cash flow. So they could, with 1 year's free cash flow and 1 year of cash, the cash in the balance sheet, they could pay off their debt. So I'm not too concerned about that. And they don't require a lot of cash to run the business. So they're a fairly cheap operation to run now that the infrastructure that they've built in the Visa network is in place. It doesn't require a lot to keep going.
Yeah, it's one of those companies where, we talk about kind of life cycle of a company, and this is a company that's generating a ton of cash flow, free cash flow. And so in that regard, enough cash to maintain its business, I think it's a firm yes. Yep. Okay, next question. Does the company maintain reasonable debt level? And we touched on this already, or unless you have any other things any other things you'd like to mention here?
No, I don't see anything there that really makes me, I don't know why they took this debt in the first place. They started doing a share buyback a few years ago. Of about $8 billion a year. But for the most part, I don't see this as being a useful, the debt level it's not terrible. I wouldn't have taken it out myself, but they have taken it out. So here we are. It's not going to blow up their business though.
Yeah. Great. Next question. Can the company generate a strong amount of free cash flow from operations? I think it's a firm yes on this one as well. Any other comments here?
Yeah,
Ari?
Just to give you an idea, in 2016 they had $5 billion in free cash flow, off of $6 billion in net income, and that grew to $10 billion in 2018 of net income, and that translates to $12 billion in free cash flow. So So yeah, they're generating a ton of free cash flow as a business.
Yeah. And, as always, as owners of the company, what we really care about is free cash flow at the end of the day.
Yep.
Cash in the bank. And it seems like this company Visa, of course, is generating a lot of that for its owners. Okay. Now let's pivot here a little bit and talk about its competitive advantage in more detail.
Yep.
And so in the beginning of the episode, I posed this question. Let's say you guys and us, all of us, you guys, the listeners and us, we came together and we had a fat wallet of, let's say $100 billion or whatever amount. Yep. Could we not only start a company, but also be a meaningful competitor to Visa? Could we do that? And if we could, what would that look like? And if we cannot, why is that the case? So let me ask you this question, Hari. What do you think it would look like for us?
Yeah, I think there are certainly companies in the Silicon Valley space who are trying to, be in this payment processing, business, right? And, when you look at PayPal, for example, PayPal kind of connects to your bank account and transfers money, to the provider through PayPal, and it tries to avoid using a credit card if it can, right? So that is kind of but again, PayPal had a big benefit to it that it existed before 9/11, where a lot of financial things were scrutinized. So, if you're trying to compete with Visa, right? What would you have to do if we had $100 billion? One, all of the chips, that are on the cards, you would have to make deals with financial institutions to provide your type of card, right? So let's call that the Becco Hari card, right? Or let's call it the value investor card, right?
There we go.
The value investor card. We would have to convince financial institutions to, issue these types of card and take credit risk. And there'd have to be something compelling for them to even do that, right? That's better than Visa, better than MasterCard, right? That they would do this and then they would also have to convince merchants to accept this type of card, right? So, the terminal that you get, right? One of the things that we didn't really talk about is Visa calls these groups the acquirers of they're financial institutions that contract with merchants to accept Visa. So they generate reports and they provide customer service for the merchant itself, right? So they're making the point of sale terminal that, reads the card and connects to the Visa network and that kind of stuff. So you'd have to convince this group also that they need to support our thing, right? And you look at it right now, they would have to say, well, why should I issue a card with the value investor card on it, as opposed to Visa or MasterCard, where they're already accepted everywhere, they're already taken. So, Becca, what would you do with that $100 billion, right? How would you approach that with with the financial institution, with the merchants, and so on? What would you do?
Yeah, I mean, I think it's a very interesting question. I think, there's so many things at play here that even if we were successful in reaching, it's really, the first thing we ask, you and I are both in the startup world. The first thing we ask when we start a company is, what is the pain point that we're trying to solve? Right?
Right.
Like, what are we trying to really solve here? And from my understanding here is that it's pretty seamless. Like, everyone's pretty happy with Visa.
Yeah.
The scale of it really helps us, the people who use the credit card. Financial institution, they can sell credit cards to people and they can boast the fact that we're partnering with Visa and you have all these network the Visa network to tap into. From the merchant perspective, they can, they can tap into this Visa network where, you can capture a large percentage of your customer base. And so if you look at these different parties involved in this whole ecosystem of financial transaction, it's pretty frictionless.
Yep.
And people are quite happy with what they have. And, going back to the question of what is the biggest pain point, I think obviously there are small pain points here and there. I think one thing that I know from talking to merchants is that if you accept credit card, you have to pay the fee, the damn fee, whatever the percentage is. Like it can really add up. So there's that pain point there. For us individuals, I think this is pretty seamless. You whip out a credit card and a piece of plastic, and you can use your money, spend your money pretty seamlessly. I don't see a lot of pain point there. Financial institutions, there might be some, again, related to more of a cost than anything else. So overall, I think it could be like a micro solution here and there to help out, with, point solutions for the merchants or point solution for the financial institutions. But to replace Visa seems like a pretty dumb idea. I mean, just going to be really plain and simple about that. Like, it's just, what are you really trying to solve here? It's pretty seamless.
Yeah, I think what you would have to do with that $100 billion is effectively give that money away to financial institutions to eat the cost of them switching over, right? In order to use you, right? Essentially, you would basically have to pay merchants, you would have to pay financial institutions to even want to use your system.
Yeah.
Right? Because they're already built up, they already have, and Visa has other things on top of it, like fraud detection and other things, reporting to the government, on, fraud, criminal types of transactions. So there's a lot of things that are already built up and built into the system that prevent Visa from, that Visa has accounted for, that you and I, who are not even, we don't know anything about this space, would have to compete with, right? So you would almost have to do what a lot of Silicon Valley companies do, which is you have to give away money in order for people to use your system, right? Mm-hmm. And then what happens when the giveaway money goes away? Are people going to stick around, right? Are you going to be able to provide a better customer service to, provide more value to your customer than Visa would, right?
Yeah, for sure.
So that's the only way you can do this. And what you see a lot of companies that have built up e-wallets and stuff like that. Like, think about Venmo, right? Venmo is owned by PayPal, and it's very easy to transact money between your friends. You all go out to dinner, somebody swipes their card, and then you pay them back, and you can do that easily with Venmo. But as the customer, Venmo doesn't generate any money off of that transaction, right? Because if I had to send you Becco money because we went out to dinner, and Venmo took 5% off of that, well, I'm going to stop using Venmo, right? because you're like, well, you pay, the dinner was $100 and I only got 95. Well, screw that. I'm not going to, don't pay me via Venmo, right? So if you're going to offer that service to the financial institution, there has to be a strong incentive. Now, Visa makes $12 billion in free cash flow that they can just say, okay, Chase, I want to squash the value investor card, out of existence. So I'll just give you $5 billion of incentives this year. Chase is going to be like, oh, screw value investor card. I don't want to have to do all the, the brain damage to, support them. You guys are going to give me more money, right? As a thing. So I think you see this with Square and Stripe and all these other services, right? They're providing more seamless transaction processing for the merchant, but they're not directly attacking Visa, right? They see that Visa is the 800-pound gorilla, and they're the 20-pound weakling in this case, and they're not going to be able to fight Visa on that, right? So they're taking off the niche things, making it easier for merchants to accept payment, that kind of stuff. But they're not getting into the business of actually competing with Visa, right? Because I think that's going to be, like I said, you're going to have to use all of that cash, that $100 billion or however much you have, to just compete with them. And I mean, think about how many companies out there today have $100 billion just lying around, right? The only two I can think of off the top of my head are Berkshire Hathaway and Apple, right? And maybe Google
SoftBank.
Google. Well, SoftBank will throw that into WeWork and Uber, and so they'll just set it on fire. So, I think it's very hard for somebody to come around and really compete with them. That doesn't mean it couldn't happen, and maybe there's more to this than you and I understand, because we're relatively naive to this space. But I think it would be very difficult to even try and attack that moat.
I agree.
And I mean, let's look at even Amex, right? Amex is in a very good position because they already provide these services, right? Could Amex lower their fees? Amex is catering to a higher net worth clientele, right? So they have much fewer cards, 100 million cards issued versus 3 billion for Visa. They don't seem to want to, take out Visa. They want to operate in their in their space, which is high net worth individuals or people with, I think there are certain areas that Amex also has things like student cards and stuff like that. It would be very, very difficult for them, to even Amex to compete with Visa in this case. So for an outsider, you would have to basically use up a lot of money to even get yourselves on the point of sale terminals, to get yourself onto these things. I think it would be very, very, very difficult to do that.
Yeah, that's really it's really interesting. The acquisition cost, the customer acquisition cost, and the fact that you basically have to run through all that money to be able to even have a dent, to even make a small little dent in the market.
Yeah.
And I think it goes back to kind of the question that I posed, like, what are you trying to solve? Like, what is the pain point here? If there is no pain point, you basically have to dish out a whole ton of cash for them to convert over.
Right.
And it's just, it would be very, very tough endeavor, to start.
Yeah, I agree. I mean, I think the whole concept behind any business is that you have to provide value to three groups, right? One is to the employees who work there. One is to the owners of the business. That means you have to make a profit. And the third, which a lot of people don't, think about, because I don't know why they don't think about this, but you have to provide value to your customer, right? Because, Visa provides a tremendous value to their customer. You don't have to carry cash. You're low risk of losing your money if you carry a card. And they can do fraud prevention, and they can do chargebacks and things like that. It's very seamless, right? So Visa is providing this tremendous value added to their customer. For Value Investor Card to be doing that and have people switch over, we have to provide more value than the existing group that's out there, right? Think about Amazon, right? Walmart existed. They sold a lot of stuff. Amazon sells a lot of stuff too, but what they provided was, next day shipping, second day shipping, and so on. And they brought a large inventory more inventory than you could find even at your local Walmart, right? So they provided an additional value that brought all the customers over to them, right? So that is fairly rare. I think most businesses can't provide enough value to all parties involved for it to be worth their while, right? And that's why what we look for as the value investors is companies that are able to satisfy those three needs, right? Because if you don't have good employees and you don't have money to provide to your ownership, and you don't provide enough value to your customer, nobody will win. Nobody will use your service.
Yeah. And it's interesting, in the absence of the value that companies provide to customers, that void is basically being filled with free cash.
Yeah.
Just all these promotions that happens.
Right. I mean, when we talked about Lyft several months ago, that was it, right? Essentially, Lyft provides a service that is subsidized. So yeah, people like, using the service, but only because they're giving you something, right?
Yeah. And then, that is value added.
Yeah.
That is value added for people getting free money. But at the end of the day, you have to satisfy the needs of the shareholders and the employees. And if the business can't do that for a long time, which it can't, you can't just give out free cash forever. The company won't exist.
Yep.
I thought this was a really interesting exercise, Ari.
Yeah, the reason that we brought this up in the first place was this is actually how Charlie Munger, he talks about inverting your thesis, right, and trying to attack your own investment thesis. And your investment thesis is largely built up around the moat, right? And so, that's a kind of an exercise that I think is worth doing for a lot of businesses that we talk about. We haven't done it until this point because, I think. This was a good exercise because, as you could hear from Becco and I, we're not the most sophisticated in terms of financial institutions. We couldn't come up with a way to beat Visa, even with $100 billion. I think it would be Visa's been around for 60 years. It would probably take us that long and that amount of money to even compete with them. And maybe we could make a dent, but we certainly wouldn't beat them at their own game.
Yeah. Yeah, for sure. Great. Should we move on to valuation?
Yeah. I think that's good.
Just a really quick note for our listeners. We are skipping over the management in this episode because we wanted to focus that time on talking about this competitive advantage and the attacking of the hypothesis that we just did. This is of course because we think that the moat itself is impenetrable. It's one of those companies where, as I said before, the word impenetrable moat can't be thrown about lightly. And it's one of those companies where it is actually quite fitting to describe their moat as impenetrable. And so with that, it really doesn't matter who's running the company.
Yeah, I think the best Warren Buffett quote to summarize that is, you want to own a business that even an idiot can run, because one day an idiot will run it. And I'm not saying that Visa is run by an idiot, or several idiots, but in this case, it doesn't really matter all that much because, it would be very difficult even for the manager of that company to disrupt the business, right? Because the board of directors would fire that guy very fast. So, management is a good management is an optional thing, in this checklist that we're talking about. It is a great thing to have, and a great manager can have a really powerful impact on a business. But you would ultimately want such a good business that it doesn't even matter.
Yeah, it's awesome. If you find a company like this,
yep,
that fits this description. Okay, let's move on to valuation. I think I'll just ask this question: Is from your analysis, Hari, is there a significant margin of safety? Is there? Can we estimate cash flow into the future? Reasonably estimate cash flow into the future? And last question: what is the downside of the unknown here? I'll ask all those questions in a bundle because a lot of it will come out of the valuation work that you've done. So, Hari,
to
take it away.
Yeah, going back to our free cash flow discussion, they had I'll throw out the numbers to start with. They generated $12 billion in free cash flow, and that number has been growing at about 15% per year for the last 5 years. So in 2018, that was $12 billion. And they currently have a market cap of $378 billion. So they're fairly large company to begin with. And they generated, as I said, $12 billion in free cash flow in 2018. And that number was $5 billion in 2016. So their free cash flow has actually been growing a little bit faster than their overall revenue growth because of incentives that they were providing to customers to as retention or incentives to use Visa as a platform. So 15% growth is what I was going to use for the next 5 years as a estimate, because I feel like it's a fairly because they have such a powerful moat, I don't see them losing out to a competitor going forward because I think they have a fairly strong competitive advantage. So 15% growth, because of their scale and their size, it would be hard for them to grow any faster than that. And then in years 6 through 10, I'm thinking more around, so 15% in 5 years was actually basically doubling their free cash flow as it is now. And I think that is fairly conservative in an estimate itself. 10% growth for years 6 through 10. And they currently have around 1,800 million shares outstanding. The one caveat to all of this is that Visa spends about $8 billion a year on share buybacks. So they're actually, earnings per share is actually growing a little bit faster than the number, and that can continue to grow because of the cannibalization of their own shares. So a couple more things before I run into the valuation itself. The 15% growth, is the more of the conservative estimate of just the free cash flow, but the earnings, as the share count decreases, that number can go up. I am also comfortable with Visa because I don't know that, although the transaction volume may decrease in a recession, I don't think people would, just stop using Visa. So if we run into a recession in the next 5 years, even a global one, even if it reduces the amount of money that Visa makes, it will only be a temporary setback. It won't, they don't have any liabilities, financial liabilities that are hinging upon a certain amount of cash flow. So I feel fairly comfortable with my being able to estimate that Visa will be around in 10 years. So with that being said, $380 billion market cap, 15% growth rate, and I always use a 10% discount rate because that's the alternative to my investment is using the S&P 500. I get a valuation of $175 a share, which is about what Visa is trading at right now, but a margin of safety price, which means there's enough of a discount to my actual estimate of share price to be safe, is around $87 a share. So right now, Visa is almost double my margin of safety price. And they're, for some other, valuation metrics to kind of just keep you in the ballpark, they're trading at about 30 times free cash flow and 37 times their earnings, price to earnings. So those numbers are very high, even with a great business like Visa. I would like that to be below 15 for each. Free cash flow below 15 for, given what I know about their growth rate, and the share buybacks would be a big, help to that. They're just too expensive, for at the current price.
So it is pretty pricey at this point. And, they're trading about 30 times free cash flow. And your margin of safety price is around $87. It's kind of double where it is now. It's one of those companies where it's very similar. I see a lot of similarities to like Nvidia, for example. I think, quality business, strong cash flow, big runway for growth. And yet, the price is not there for us as value investors. I see a lot of similarities in that regard. It's one of those companies where, it's excellent, and it's one of those companies that you have to put it in your watch list in case it comes down. And when it does come down, it's one of those companies where you can really pounce on and deploy your money, and you can make a lot of money subsequently because of the things that we talked about, namely the competitive advantage and the scale that it has.
Yeah, and at the right price, I mean, if you bought into it, let's say it magically dropped to $80 a share tomorrow. I mean, this would be a company that you would just buy and never sell, right? I mean, there would be no reason to ever sell it, right? This will just continue to compound money over time as they'll be able to buy back shares and things like that. So I would be very comfortable buying shares into this, but only at the right price, right? And that's the hard part about value investing is maybe you have extra cash available and but you can't buy in. You find a great company, that's a great business. You could even set this thing on autopilot, but if you pay too much, that's how you don't make any money off of a good investment, right? And so even if you paid $100 a share, right, you'd still do very well, right? In the long term. But at this price, it's too expensive, and I think this is a company that you would want to buy at a recession, something like that hits, the price comes down significantly. That it'll bounce back well when the market or when the economy recovers. So you would be comfortable buying it and holding it for the long term.
Yeah.
Right?
Yeah, exactly. Definitely to keep on your watch list and ours, Visa. It's been really interesting, doing a deep dive into Visa.
Yeah.
I think we'll end it there for this episode. Any additional comments you want to make, Hari, before we close out here?
No, I think first of all, I think it's it's good that we are very lucky that we have a fan base that sends us emails and listeners who are very engaged, and we really appreciate that. That is how the reason that why Becco and I just keep doing this is that you all ask us great questions. You come up with great things for us to keep talking about. So we love that. Please continue to do so. You can reach us at info@valueinvestor.org. And we will try and find ways for this community that we're building to be more, so that we can talk to you guys and you can talk to each other as well, going forward. So yeah, exactly. We are super excited about the possibility of creating this community with you guys. I think it'll help all of us get better. Okay, we'll end it there. For this episode, Visa. It was really interesting deep dive into the company. Thank you, Hari, for all the work. Yeah,
and thank you guys for sending in the request. We'll see you guys in the next episode.
Yeah, thank you.
Thanks.